So how in the world do you actually make a physical diamond tradable like it's a share of Apple stock? Well, the magic really happens when you merge the physical world of gemstones with the digital world of the blockchain. Let's take a look at the core tech that makes all this possible.
Okay, the key concept here. The big word you need to know is tokenization. The simplest way to think about it is like creating a digital title or a deed for a real-world object. So instead of having a piece of paper locked in a safe somewhere, you hold a super secure digital token that proves, without a doubt, that you own that thing.
And this brings us to an acronym you are going to be hearing everywhere pretty soon. RWA. It stands for Real World Asset. And yeah, it's exactly what it sounds like. It's a physical thing, could be a house, a bar of gold, or in this case, a diamond, that now has a digital twin, a token, representing it. This is the critical link between our physical and digital economies.
And that brings us right to the project at the heart of our explainer today, the one that's taking this RWA technology and applying it directly to the diamond market, KimberLite.
So what is KimberLite in a nutshell? Well, it's a platform that takes rough diamonds and turns them into these digital tokens called eDiamonds. What's cool is you can trade whole eDiamonds or even tiny little fractions, which they call eCarats, on their own marketplace 24/7. But here's a really juicy part for people who hold the token. The project actually shares 11.5% of its profits directly with them. And of course, the whole system is secured by audited smart contracts, which basically means it's built to be safe and reliable.
All right, let's pop the hood and look at the engine of this whole thing, the tokenomics. This is the financial DNA, the rules of the road that makes the entire project work.
Everything, and I mean everything, starts with this one number, 200 million. That is the total, fixed, absolute maximum number of KimberLite tokens that will ever exist. It's the whole pie. And every single thing we look at from now on is just a slice of this.
So here's a bird's eye view of how that 200 million token pie gets carved up. You can see the biggest chunk, 44%, is set aside for growing the whole ecosystem and for future investors. Then you got significant slices for the team, for marketing, and for making sure there's enough liquidity so trading is smooth. This gives us a really clear picture of where the value is being directed.
Okay, now let's zoom in a little bit on the funds meant to actually run the show. A really solid chunk, 34% or 68 million tokens, is specifically set aside to build and grow the platform. That's broken down between actually developing the project, paying the core team, and then of course money from marketing and bringing on strategic partners. This is basically the fuel that's going to power the project's growth.
So we know where the tokens are going, but how did the project get its initial funding to even get started? Let's check out the fundraising roadmap.
Right, so they raised money in different stages. You can see the price per token went up each time from just 10 cents for the super early believers all the way to 20 cents for the public. But check out the trade-off here. Those first investors got the absolute best price, but their tokens were 100% locked at the TGE. That's the token generation event, just a fancy term for launch day. They couldn't sell a single one. Meanwhile, folks who came in later paid more but got to unlock 10% of their tokens right away.
And this timeline here shows us exactly how those tokens get unlocked over time. It's a concept called vesting. So after that first 10% is released on day one, there's a 1-month cliff where absolutely nothing happens. Then tokens start to get released slowly, month by month. Now, why would they do this? It's simple. It stops early investors from dumping all their cheap tokens on the market at once, which could totally crash the price. It's a built-in stability feature.
And all of this, the vesting, the token allocation, it all points to one central theme. This project is being designed for long-term health, not just a quick, flashy launch. And nothing, I mean nothing, demonstrates that more than this next detail.
Okay, you gotta lean in for this one, because this is a huge deal. The core team's own tokens. They are locked solid for 5 full years. They literally cannot sell a single token. And even after that, their tokens only unlock gradually over another full year. In the world of crypto, where everything moves at lightning speed, a 6-year commitment like this is, well, it's almost unheard of. It basically ties the team's financial success directly to the long-term success of the project.
All right, let's wrap up with 3 key numbers that are going to define the public launch. First up, the initial listing price. The token is set to start trading at 22 cents. Now, based on that 22-cent price, the initial market cap, which is just the total value of all the tokens actually available to trade on day one, will be only $264,000. For a project with this kind of ambition, that's a really low starting point, which suggests there could be a lot of room to grow.
And finally, we have the fully diluted valuation, or FDV. This is the project's total value if all 200 million tokens were magically in circulation right now. And that comes out to $44 million. The huge gap between that tiny initial market cap of 264 grand and the $44 million FDV, well, it tells the whole story. The vast, vast majority of tokens are locked up tight, reinforcing that long-term vision.
So KimberLite is taking a shot at tokenizing the $100 billion diamond market. But this is just one piece of a much, much bigger puzzle. We're seeing this happen with everything: real estate, fine art, even classic cars. Any valuable physical asset is now on the table. Which leaves us with the really big question: is this the beginning of the end for investing as we know it? Are we watching the tokenization of, well, everything?